So welcome back everyone. In this new lecture we are going to start the discussion from question number 13 onwards. We are going to officially enter into the second part or second phase of the mergers and acquisition, in which we are going to discuss these concepts. So let's have a look on some of the concepts. First we are going to start with the true cost of merger. So this is question number 13 in front of you. 13, 14, 15, these are the questions on the cash deal, stock deal, true cost of merger, cost of acquisition, and so on. Have a look. Elron Limited plans to acquire Doom Limited. Okay, there are two companies, Elron and Doom. So Elron Limited is an acquirer, Doom Limited is a target company. The relevant financial details of the two firms prior to the merger announcement are as follows. Okay. The market price of both the companies is 50 and 25. You can see the target company's market price is just half of the acquirer. Number of share outstanding is also half of the acquirer. The merger is expected to generate gains which have a present value of 200 lakhs. In your compiler itself, please write down, this is called as synergy. I told you 2 plus 2 can be 5. It's not just 4. So 2 plus 2 is 4, but if the answer is 5, that means 1 is your synergy gain. The gain that could not be achieved by operating your business individually. It can only be achieved when you get merged with the other company. So practical example of this is, let's say for example, Tata Motors is automobile company. They manufacture the cars and sell it in the market. And right now if they are purchasing the raw material, let's say tire from MRF, and that is their vendor, right? So if they buy MRF tire company itself, the entire MRF, so what will happen? That will increase their synergy benefits. So MRF is charging some profit at present. If you will understand the process, MRF will charge some profit over the cost and then sell it to the Tata Motors. But that Tata Motors can bring down the cost of the tires by acquiring the entire company. That extra profit that MRF is charging to the Tata Motors, that can come down by buying this company. So this extra profit can only be achieved by operating in a merged situation. So that's extra profit of 1 is called as the synergy benefit. Okay. Another example of that is, let's say for example, right now Bharti Airtel, Jio and Vodafone Idea. Nobody is using that, I think so. But these two, Bharti Airtel and Jio, is working or operating in the entire country. Okay. What if both the firm gets merged into each other? They can have some kind of a monopoly in the market. They can charge a little higher amount to the customer. So they will have some advantage over operating independently. Both of them are right now operating independently and fighting against each other, right? This competition can get reduced and the burden on the customer can be increased by raising the tariff plans. So this extra benefit will be called as a synergy benefit. This can only be achieved by merging together. So if both of these companies, Elron and Doom Limited, gets merged together, the present value of the gain or the synergy benefit is 200 lakhs. Okay. Exchange ratio agreed is 0.5. What does that mean? It means that instead of 10 lakh, in place of 10 lakh shares, we are going to give them only 5 lakh shares because the exchange ratio is 0.5. What is the true cost of merger from the point of view of Elron Limited? Now try to understand. The current market value of Elron Limited is 50 into 20, that's 1000 lakhs, and the Doom Limited is 250 lakhs. If both the firms get merged, the total value will be 1000, 250 and 200 of the synergy benefit. Elron, target and synergy benefit. So the total value will be 1450 of the merged company. This will be the total value. Now, how many shares Doom Limited will get in the merged entity? 5 lakh shares. So the current number of shares with the Elron Limited is 20 lakhs. 5 more lakh shares will be issued by the Elron Limited. The total number of share will go to 25 lakh. Now, 1450 lakhs of the company will be divided into two parts of the shareholder. One will be holding 20 lakh shares, that is the old shareholder of Elron Limited, and the other 5 lakh shares of this company will be held by the shareholders of Doom Limited. So if you will calculate, it will come to like 5 by 25, that's 20% of the entire business, and 80% of the entire business is distributed to Elron Limited and Doom Limited shareholder. What is the market value after merger for Doom Limited? It's 1450 into 20%, that's 290 lakhs, right? 290 lakhs is the value of the shareholders of Doom Limited after merger, and before merger it was 250 lakhs only. So how much benefit that they are getting? 250. They are getting a benefit of 40 lakh rupees, isn't it? This is after merger situation of Doom Limited shareholder. This is before merger situation of Doom Limited shareholders. So due to this merger, because of the Elron Limited asked the Doom Limited to get merged in this company, their market value has been increased by 40 lakh rupees. Their gain has become the cost to us. Practically, I am not satisfied with the answer, but that's what the institute is saying, that 40 lakh is the true cost of merger. It's actually not a cost of the merger to the Elron Limited, because if you look from the Elron Limited's point of view, the market value after merger for Elron Limited comes to 1160 lakhs, whereas the before merger value was 1000 lakhs. So the gain to the Elron Limited is also 160 lakhs. So who is bearing the cost? No one is bearing the cost. Both of the parties are gaining from this merger. There is no, practically speaking, there is no cost to any company. I don't know why the institute is saying the true cost of merger will be 40 lakhs. It's not always that the gain of the other party becomes the loss of or the cost of the first party. No, in this case, we are gaining 200 lakhs, right? This 200 lakhs is distributed in terms of 20% and 80%. So the Doom Limited is also gaining in market value at 40 lakhs. We are also gaining in 160 lakhs. So it's the win-win situation for both of us. There is no true cost of merger. So what to do in exam in this situation? Do as it is. What is given in the question. Do this only if you want to get the marks. 40 lakhs will be called as the true cost of merger. How to calculate 40 lakhs? Sir, it's after merger market value of the target company and before merger market value of the target company. The difference between these two. In a sense, you can say it is a true cost of merger because we acquired 250 lakhs of the company and given them 290 lakhs of the value in our company. So practically speaking, we have increased their share of by 40 lakhs. But the other way of looking at this is, because the Doom Limited also accepted your request of merger, you are gaining 200 lakhs in the synergy benefit. That 200 lakhs of the synergy benefit is not just because of the acquirer or not just because of the Doom. So nobody can take the credit. Elron Limited cannot say that I have given you 40 lakhs out of those synergy benefit. No. Elron Limited cannot say that. Also, Doom Limited cannot say that I have given you 160 lakhs rupees out of the synergy benefit. No, this 200 lakhs is no one's amount independently. It can be only achieved by merging together. So both the people or both the company will have a credit in that. So nobody can say that 40 lakhs is what I have given you or a cost to my company. No. My company's value was 1000 lakh rupees earlier and now it is 1160. So it's the benefit to me. What kind of cost? No, it's not. I could have said that 40 lakhs is the cost to me only if that entire 200 lakh rupees would have belonged to me. And then I would have said that I have shared 40 lakhs of the synergy benefit with you because earlier it was only mine. No. If I can say that it was only mine, then only this becomes the true cost of merger. So this is it. The next question is going to give you a proper picture on the true cost of merger. Acha, this is again the same question. This is what you are going to take. X limited and Y limited. See, market price and the number of share outstanding, the total will be 800 lakhs, and in this case it will be 200 lakhs. Okay, the present value of the synergy benefit is 120. So if you will add 120, the total market value after the merger will be 1120 lakhs. Okay, now the exchange ratio is 1 share of it for 2 shares of Y limited. So again the exchange ratio is coming to 0.5. Instead of 5 lakh, we are going to give them 2.5 lakh shares of X limited. X limited shares after merger will become 10 lakh plus 2.5 lakh, that's 12.5 lakh. So this 12.5 lakh is the number of share after merger. 1120 is the market value after merger. This market value is divided into two parts: 10 lakhs of the X limited shareholder and 2.5 lakh of the Y limited shareholder. So what is the ratio? So 2.5 divided by 12.5. The ratio is again 20 and 80%. So if I want to divide 1120 into 20%, that comes to 224 lakh. 1120 into 80%, that comes to 896 lakhs, right? So this is after merger market value of both the companies, X and Y. Before merger market value was 800 and 200. So practically speaking, both the companies are gaining. It's a gain to both the companies, 96 lakhs and 24 lakh. In this question also they have said that 24 lakh is the true cost of merger. Do you really think that 24 lakh is the true cost of merger to X limited, the acquirer? No sir, it's not the merger cost. I can say that 24 lakh rupees is the true cost of merger to me only if that 120 lakh rupees of the entire synergy benefit belongs to X limited, but it is not the fact. So this is exactly the same question asked in December 21 with the different figures. Now you are going to get a clear picture of what is the cost of acquisition in question number 15. Given is the following information: day limited and night limited. See, the net earnings is 5 crore and 3.5 crore. If you merge, the total earning will be around 8.5 crore. Number of equity shares are given. You can calculate the EPS with this. The shares of day limited and night limited trade at 20 and 15 times their respective PE ratio. So we can calculate the market price as well. Just have a look if that is possible. Day limited, night limited. So net earning is 5 crore. This is 3.5 crore. Number of share is 10 lakhs. That means 0.1 crore and 0.07 crore. So if I want to calculate EPS, that is 50. Yeah. EPS is 50 and EPS is 50 in both the cases. PE ratio is 20 and 15. So market price is 1000 and 750 of both the companies. If you want to calculate the market value of both the companies, you can just multiply the market price with the number of share. So it will be in crores, 1000 into, if we want to calculate it in, we will do it in crores only. So 1000 into 0.1, that's 100 crore, and 750 into 0.07 is 52.5 crore. So this is the current market value of both the companies independently in terms of crore. If we want to buy Night Limited, please understand, if we want to buy Night Limited, we are buying a company of 52.5 crore rupees. Now, Day Limited considers taking over the Night Limited by paying 55 crores, considering that the market price of Night Limited reflects its true value. Market price of Night Limited, which is coming to 750, it is saying that it reflects true value. So the true cost of company is the 52.5 crore, and for buying that company we are paying 55 crore rupees. It is considering both the following option. So understand that we have to make a payment of, Day Limited will make a payment of 55 crore to N Limited, but this purchase consideration is to be given in cash or stock? That's what the question is. If it is to be given in cash, the question is very simple. You are giving them 55 crore rupees to acquire 52.5 crore of the company. So the true cost of acquisition to you is 2.5 crore. Just try to understand. Now you are taking a company of 52.5 crore and you are giving them a cash of 55 crore. So practically speaking, you are giving them 2.5 crore more. That's the cost of acquisition to you. Okay. Second is the takeover is funded entirely by stock. You are required to calculate the cost of the takeover and advise Day Limited on the best alternative. Day Limited is the acquirer. Whether this Day Limited should buy the Night Limited in cash or in stock. If we buy it in cash, our cost is 2.50 crore. If we buy it in stock, what will be our cost? It's very simple. Now in this case, what are you going to do? You are going to make it simple. If you buy this company, the after merger market value, because no synergy benefit is given in this question as compared to the previous two questions, we will assume the synergy benefit is 0. So if the synergy benefit is 0, 800 plus 200, that is 1000 is the market value in the previous question. And in the previous question of that, what would have been the market value? 1000 plus 250, 1250. If there is a synergy benefit, it will be given 200 lakhs. So in this question, what will be the market value? After merger, 100, 52.5, that's 152.5. 152.5. Now, understand that 152.50 will be the market value of the merged entity. How many shares are you going to distribute to Night Limited? How many shares you should distribute to Night Limited? See, you said that you will pay 55 crore rupees to Night Limited. So if you pay it in terms of your company share, every share is worth 1000 rupees for Day Limited. So practically speaking, in order to distribute 55 crore rupees of share at 1000, you will have to issue around 0.055 lakhs. That means 5,50,000 shares of your company, if I'm right. When you will give them 5,50,000 shares of your company, that would mean you have given them 55 crore worth of shares, because takeover is funded entirely by stock. So you give them the stock worth 55 crore. Where every stock of your company is 1000, you have to issue 5,50,000 shares. Okay. So after merger, the entire market value will be distributed in 10 and 5.5. 10 lakh is the old shareholders, 5.5 is the new shareholders. So 5.5 divided by 15.5 comes to 35.48% of the holding. And this will be 64.52% of the holding. So can you see that the target company is getting 35.48% of the company's stock? Now, what is the market value after merger to these guys? 35.48% of 152.50. It's just like 20%. See, it's just like 20% of 1120. Right? In the same way we are doing it now, 35.48% of 152.50. That comes to 54.107. So you have given them 54.107 crore worth of stock and bought a company worth 52.50 crore. Am I right? $52.50. So the true cost of merger to you is 1.607. It's 1.607. Now you will say, sir, where exactly is the 55 crore? 55 crore has been diluted now. It's diluted to 54.107 crore. You gave them 55 crore rupees at 1000 rupees, but since the number of shares are increased in the company, the total market price has been diluted and came down to 54.107. So practically speaking, 1.607 should be the cost to the acquirer. Now try to understand it in a different way. 64.52% is the stake of acquirer in the after merged company. That comes to 98.393. That comes to 98.393. Before merger, this is after merger, but before merger their market value was 100 crore. So practically they are losing 1.607 crore due to this merger. If they fund the entire acquisition in terms of stock, but still it is profitable than losing out 2.50 crore. So in both the cases you are losing money. Obviously that's a cost of acquisition to you, but which cost would you prefer? The lowest one. So it is preferable to buy this company or acquire this company in terms of stock. Obviously your stock value of 100 crore has come down to 98.393 crore. 1.607 crore is a loss to you in order to acquire this company. But yeah, if we will look at the answer, this is 1 crore 52.5, this is 2.5 crore if you fund entirely by the cash. But if you fund entirely by the stock, the answer is little different in this question by the institute. I just have a look. The number of share to be issued to Knight Limited is 5,50,000 because you want to distribute 55 crore at 1,000 rupees of the market value of acquirer's share price. So 5,50,000. Earlier 10 lakh shares were there. Now you are issuing 5,50,000. So total will be 15,50,000. So you can see proportion that Knight Limited shareholder get in Day Limited's capital structure is 35.48%. Out of 15.5 lakh shares, 5.5 lakh will be held by the target company in the after merged company. Cool, sir. What is the true cost of merger? Now this is where I feel the answer is wrong. This is correct, that the total market value after merger is 152.50, of which 35.48% is held by 152.50 into 35.48% is held by the target company shareholder. That means how much of the total market value is held by the target company shareholder? 54.107. And this is what we paid to the shareholder for buying a company of 52.507. So the answer should have been like this. You cannot take 55 crore here. You cannot take 55 crore here because this is the amount that you have given them. You have given them this much of the shares and you are also giving them 55 crore. So both the values the institute has written here is an outflow or payment by acquirer. Where is the benefit? The true cost of merger is like what you are getting and what you are paying, the difference of that. So you are getting 52.50 worth of company and you are paying 54.107 in reality. So 1.607 is your cost. So the answer seems wrong here. It's not a printing mistake. It's just a mistake by the institute until the institute changes the answer. Since true cost is negative in case of funding from stock, Day Limited would be better off by funding the takeover by stock. So my answer will be, obviously, Day Limited should take over the fund by stock. Fund the takeover by stock because 2.5 crore is still higher than 1.607 crore. If this is both of these is this has to be a loss to the acquirer, then 1.607 should be preferable because this cost is preferable instead of this cost. Why you would buy the same thing at 2.5 crore when you can get it at 1.607 crore? So go for 1.607. That's the proper picture. You can also analyze that what is the meaning of 54.107 and 55 crore. Both are the outflows to us. You might ask this question, sir, when we have given them 55 crore worth of share, then how can we say that 54.107 crore is their market value? Yes, we can say that because by giving 55 crore, by increasing the number of share in our company, the market value has diluted. And that's why they are also suffering a little loss, 55 to 54. That's 0.893 crore is the loss that they have suffered. But practically speaking, that they are ultimately at a gain only. Now 52.50 is the market value, was the market value of their company before merger. So in place of 52.50, they are getting 54.107. So this is what will give you the clear picture. Have a look on question number 16 now. Okay, let's have a look on this now. Long Limited is planning to acquire Toll Limited with the following data available for both the companies. Long Limited, Toll Limited. Expected EPS. So what do you mean by expected? EPS 1, DPS 1. So we are going to use the Gordon's growth model in this question. That's why expected. EPS, DPS, number of shares, current market price. Okay, if number of shares and the current market prices are given, I think we should first calculate the existing market value of both the companies. That comes to around 5400 lakhs. This is 5400 lakhs and this is 900 lakhs. Okay, so combined value is 6300 lakhs. So in terms of lakhs, we can write it like this. As per the estimate of Toll Limited, this is the target company, this is acquirer, is expected to have a steady growth of earnings and dividends to the tune of 6% per annum. However, under the new management, that means after merger, the growth rate is likely to be 8% per annum. If it doesn't get merged, the growth rate in this company will be 6%, but if it gets merged, the growth rate in continuing this company will be 8% without any additional investment. Okay. Calculate the net cost of acquisition by Long Limited if 60 rupees is paid for each share of Toll Limited. That's it. Directly 60 rupees. This is a cash deal, sir. If you are paying 60 rupees for each share, what is the cost of acquisition to you? Very simple. You are buying a company which has a share price of 50 rupees and you are buying it at 60 rupees. That means how much extra you are paying? 10 rupees per share. And the total number of shares is 18 lakh rupees. 18 lakh numbers, right? So if you multiply 18 lakhs by 10, that will be 1 crore 80 lakh rupees of the cost of acquisition to you. Very simple. How much you are paying and how much you are getting? You are paying 60 rupees for each share and you are getting only 50 rupees. So you can just simply calculate in a single statement instead of writing this much. It's like this: 60 minus 50 into 18 lakhs. And that will be your 1 crore 80 lakh. That's it. Let me just write it here. We can write it like this only, na? Net cost of acquisition in a single statement in a row, you can complete the answer. Okay. Second, if the agreed exchange ratio, this was a cash deal. Okay, the first question was that we are acquiring the company in cash and now we are acquiring the company by giving the shares of our company. This is where the calculations gets complicated. If the exchange ratio is 1 share for every 3 shares of Toll Limited, so the ratio is 1:3. So instead of 18 lakh shares, we are going to issue 6 lakh shares. Do you agree? 1:3, 18 divided by 3. In lieu of the cash acquisition, as per one above, that means as compared to this above, if we agree to give them share and not the cash, then what will be the net cost of acquisition? Understand, the net cost of acquisition is what is the market value of those shares after merger and what is the market value before merger. Very simple. So after merger, the market value of 6 lakh shares will be the value that we have given to them. That's what we have been calculating in the previous 2-3 questions. I will just show you. In the first question of Elron Limited, we calculated the market value shared. First we calculated the total market value, then we calculated how much is the share held by the previous share, the target company shareholder. So we divided 1450 into 20% to get the after merger market value and compared it with the before merger market value. So this became the cost of acquisition for us. That is the true cost of merger. You can call it as a cost of acquisition as well. In the next question also we did the same thing. Of 1120, 1120 was the market value. We found out how much is the total shareholding by the target company shareholder in the after merger value. So we compared the after merger, we compared the before merger, and we came to a conclusion that the cost of acquisition is 24 lakh. Now in this question also we are going to do the same thing. So what was that? How much we have given to them and how much we have received. We have received or acquired a company of 200 lakhs and given them a shareholding of 224 lakhs in the after merger company, right? Do the same thing in this question. Calculate the total market value of the company after merger and find out the holding of those shareholders. So the target company shareholders will hold this much of the value and we have got this much of the value in acquisition. See, there are 2-3 ways to solve this question. I will just explain few things. Second part. So we have two different methods to calculate the cost of acquisition. Let's first go through the normal method. We will take total earnings of both the companies. How do you take the total earning of both the companies? Try to understand. It's 12 rupees of the EPS multiplied by the number of share, 30 lakhs. So it will be 12 into 30 lakhs plus 5 rupees of the EPS of Toll Limited into 18 lakhs. So 12 into 30, 360 lakhs, 18 into 5, 40, 90 lakhs. So that comes to 450 lakhs. This is the total earning. Now let's take the PE ratio. Normally we assume that after merger also the acquirer's PE ratio will continue. The acquirer's market price is 180, EPS is 12, so the PE ratio will be 15. What happens when we multiply the total earnings with the PE ratio? We get the total market value of merged entity. That's 450 into 15. That means 6750 lakhs. So this is the total market value of the merged entity, and try to understand holding of Toll Limited's share. How much is the total holding? Total number of share that they will be receiving is 6 lakhs. That is 18 lakhs into 1 by 3. And the total number of share that will be there after the merger is 30 lakhs. That is existing shares plus 6 lakhs. Am I right? So the holding comes to 16.67%. Means Toll Limited shareholders are holding 16.67% of the after merger market value. Market value of Toll Limited's shares. So it comes to 11 lakh 6750 divided by 36 into 6 lakhs. That 11 lakh 1125 lakhs. So this is the market value of the Toll Limited shareholder after merger in a merged entity. But market value of Toll Limited after merger, and this is Toll Limited before merger, it was 900 lakhs. See, we had calculated that as 900 lakh was the value of these Toll Limited shareholder before merger, and after merger it will be 1125. That is the difference, cost of acquisition. That is what we have been calculating in the previous questions as well. 225 lakhs. This is one. Alternative method is there because we have been given with the growth rates. Alternatively, we can calculate First of all, I will calculate the cost of equity, existing cost of equity of Toll Limited. Try to understand. Cost of equity is equal to D1 divided by market price plus growth rate. Dividend is 3 rupees, market price is 50 and the growth rate, current growth rate is 6% only. If you solve this equation, 3 by 50 plus 0.06, the current cost of equity comes to 12%. I am going to use this cost of equity in after merger market value. Now, after merger, what will happen? The growth rate will change. So market price will be D1 divided by cost of equity minus growth, right? So D1 is 3, cost of equity 0.12 and the growth rate is 0.08. So market price will become 75. Market price will be 75 of Toll Limited shares. Okay. Now, yes. So what is the total market value of Toll Limited? It's 75 into 18 lakh. That comes to 1350 lakhs. This is what the market value will be of Toll Limited after merger. Total market value of which is the another company, Long Limited. It's right now how much? Long Limited is holding 5400 lakhs. Now can I say 6750 lakhs is the market value of merged entity? It's the same as this that we had calculated, total market value of the merged entity 6750, and rest of the figures will be same. From here onwards, holding of Toll Limited and all that, everything will be same. I will just continue. Holding of Toll Limited is 16.67%. Market value of Toll Limited in merged entity will be 1125. Market value of Toll Limited before merger was 900 lakhs. So that's 225 lakhs. Again the same answer. So you calculate it this way because the growth rates were given. We used the Gordon's growth model for Toll Limited and we arrived at the same figure of 6750 lakhs. Or otherwise, if you have solved the previous question or the initial questions of mergers and acquisition, we used to do the total earnings and then used to keep the P ratio constant, and then this was the process. This way also the answer will be same. There is one more way where you do not consider the synergy benefit. The third alternative can be like this. Market value of merged entity without synergy. It's very simple. It's the total of both 5400 lakhs and 900 lakhs. So 5400 plus 900 comes to 63 lakhs. 6300 lakhs. 5400 lakhs plus 63 lakhs. 5400 lakhs plus 900 lakhs. So that comes to 6300 lakhs. That's the total market value of the merged entity without considering any of the synergy. 5400 plus 900. In the previous question also we did the same thing. Market value 1000 plus 52.50. So that was 152.50 crore. 100 crore and 52.50 crore was 152.50 crore. So if you go by this way, the answer still will be correct. holding of Toll Limited is again 16.67%, or we can calculate it like this: 16.67%, 6300 into 16.66667%, that comes to 1050. So market value of Toll Limited in merged entity, that's 1050 lakhs. Before merger it was 900 lakhs. So cost of acquisition to us, or the gain to them, is 1050 minus 900, that's 150 lakhs. So here the answer will change. Instead of 225 lakh, it will come to 150 lakhs. So you can write down any of the answer. Both the answers are right from the institute's point of view. I will just show you. This was the question asked in July 2021. So recent question. 225, 180. Let me just check once again. I think I am going wrong somewhere. Value of consideration paid for acquisition. So if you go by this way, this is also correct. This 150, because we have solved the question exactly in this manner. See, I will show you. So there are 3 different answers, you can see. Market value of the merged firm. If you solve it exactly like the previous question, then yeah, this is the total number of shares that you will issue. In this question it is 6 lakhs. In the new question it is 6 lakhs. So what will happen? The total market value of the merged firm will be the total of both. Proportion, it was 16.67 proportion, 6 lakhs and 36 lakhs. So it was 16.67. So what are you going to do? The true cost of merger will be 152 point, or we can say whatever was the total, into 35.48% or 16.67%. So this answer is also right, that we have calculated. Now the fourth alternative to this answer is going to be this. Institute has taken it plain and simple, that if we are offering 6 lakh shares of our company and every share is worth 180, then you are offering 6 into 180 to them. I am telling you the difference, what will happen. You are offering practically 6 into 180 to them. That comes to 1080. Alright. 6 lakhs into 180 to them, that comes to value of consideration paid for acquisition of Toll Limited is 1080 lakhs. The previous value was 900, so the net cost of acquisition is coming to 180. But I will tell you one thing, try to understand. What will happen when you offer 6 lakh shares? When you will offer 6 lakh shares, the total number of shares will be 36 lakhs. Okay, and the total market value will be your 5400 plus 900, that's 6300 lakhs. When you divide it by 36, that will come to 175 and not 180. Okay, so 175 multiplied by those 6 lakh shares that you have offered comes to 1050, minus the previous holding was 900. So ultimate answer will be 150 lakhs that we have calculated. What the institute is doing here is that they are keeping the 180 price after merger also same, but after merger the market price will decline from 180 to 175. It's the same like the previous question. I will tell you here. See, after merger the market, we had given them 55 crore worth of shares. Now the value of their share is only 54, because the market price per share declines, because the number of shares gets increased. So because of the dilution, you have come to 150 lakhs. Practically speaking, it will look like they are getting 180 lakhs of the extra profit, or the cost of acquisition is 180 lakhs to us, or it will look like the value of consideration paid to them is 1080 lakhs, but in reality it will only be 1050 lakhs after merger. So there are 2-3 answers possible to this, and you can argue on all the answers like, okay, this can be the change, this can be the change, because there are 2-3 ways to calculate the same answer. I will suggest you to go with this 225. That is more appropriate by 2 reasons. I will tell you why it is more appropriate. First of all, the growth rates were given in the question that we are using in this method. Otherwise, you can clearly see in this method we are not using any data given in the question. Apart from that, this is the method also which is giving 225 lakh rupees of the cost of acquisition, and this is the method we have been using from the start of the question, like do the total of earnings of both and then multiply with the PE ratio and then calculate the market price. So I am in favor of the first 2 methods in this question. Okay, the third part, calculate the gain from acquisition. It's very easy, sir. What is the total cost or total market value after merger, and what was the before market value, before merger market value? So it's very simple. Total earnings of long term limited is 450 lakhs, as we discussed. When you multiply it with PE ratio 15, it comes to 6750 lakhs. So in the third part also they are following the market value of 6750. So I would suggest you in all the 3 parts you follow 6750 after merger market value only, and not just, there are 2-3 ways to calculate the market value. One is this, okay. The second one will be the market value of target and market value of acquirer, which comes to 6300 lakhs, not 6750. Okay, so this is the value of long limited after acquisition, and before acquisition the total value of both were 6300 lakhs. So the total profit because of the acquisition is 450 lakhs. Understand that independently both the companies had a market value of 6300 lakhs. But because of the PE ratio, you can say we have a market value now of 6750 lakhs. So to both the types of investor, the total gain is 450 lakhs. Out of this 450 lakhs, I will again tell you that 6 by 36 is shared by 450 into 6 by 36. That's 75. Yes. We can divide this gain into both the investors. So 6 by 36, 6750 divided by 36 lakhs, that's 187.50. So if I want to calculate for these guys, 187.50 into 30, it comes to 5625. 5625, and for these guys it comes to 1125, right? See, so this 450 can also be divided into 6 by 36 and 30 by 36. That's 75. 70. No, it won't be divided like this because value is changing for both. These guys are getting 6 lakh shares now, so their value is 1125 now, 1125. So practically speaking, this is the total gain from acquisition. I was just trying to calculate few more things out of it, but the data is not like that. So this was July 2021 question. There are some ambiguities there where you can like ask few things, that how to solve the second part. The second part asks about the net cost of acquisition. I would suggest you to go with the Gordon's model, because in that case you are using the given data as well. But also this part is also right, 180 lakhs. Again, 150 lakhs of this part cannot be denied. This is another way of looking at the question. So there are 2-3 answers possible. Come over to question number 17 now. Okay. So Simpson Limited is considering a merger with Wilson Limited. The data below are in the hands of both the directors. The issue at hand is how many shares of Simpson should be exchanged for Wilson Limited. Both boards are considering three possibilities that we should give 20,000, 25,000 and 30,000 shares. You are required to construct a table demonstrating the potential impact of each scheme on each set of shareholder. So try to understand, one company is want to buy the other company. The issue at hand is how many shares should be given to them. For Wilson Limited, you can see the total number of shares outstanding are 10,000. The total number of share outstanding are 10,000. So as against 10,000 share, should we give 20,000 of our share, 25,000 or 30,000 of our share? We have to find out that what if all the schemes are implemented, so what will be the profit or loss to both the companies in terms of market value? And it's very simple, sir. First of all, you will have to calculate the market value for both the shares after merger market value of both the shareholder in 35 lakh. Try to understand. Before merger market value is 20 lakh, before merger market value is 10 lakh for both the firms. So we are ready with the before merger market value. The only thing that you have to calculate is how much is the percentage of shareholding of Wilson and Simpson in the after merger market value, because that is also given, which is 35 lakh. So we have to distribute 35 lakh in that shareholding pattern. And it's very simple, sir. If you issue 20,000 share, if this is the Simpson acquirer, this is target. If you are going to issue 20,000 share, the total shareholding for you will become 70,000. Do you agree? 50 plus 20. Now the shareholding pattern will look like 5/7 and 2/7. Are you okay with this? 5/7 is the old shareholder, 2/7 is the new shareholder. Now divide the 35 lakh rupees of the combined merged value in 5/7 and 2/7 and then deduct the pre-merger market value of each firm. Out of it, you will get the gain or loss. I will just show you here. See, this is 2/7, this is 5/7. So what I did, to 35 lakh, I divided it into 2/7, that came to 10 lakhs, and this is coming to 25 lakhs. So total is how much? 35 lakhs. This is the value of the shares owned. 10 lakhs and 25 lakhs. I think one more thing should have been there. Which is the pre-merger market value, which is not taken here. The pre-merger market value of both the firms were 20 and 10. So pre-merger market value was 10 lakh for Wilson and 20 lakhs for Simpson. This is acquirer, this is target. So can you explain, can you say that 5 lakh is the profit to acquirer? This is the impact. What is the impact? Increase in the market value is 5 lakh to acquirer, but there is no increase in the market value of target, because earlier also it was 10 lakh, now also it is 10 lakh. So if you offer 25,000 share, the total will become 50 plus 25 for the acquirer company. The total will be 75,000. Now the ratios will be 50/75, 25/75. So it will be 1:3 and 2:3. This is going to be 25/75. This will be 50/75. So 1:3, 2:3. Now divide the entire 35 lakh into 1:3 and 2:3 and then compare it with the pre-merger market value. You can see that now the target company is gaining around 1,66,667, because earlier the market value was 10 lakh. Now the market value is 11,66,000. So the gain here is 166,667. And the gain here is 333,333. Try to understand, the total gain will be restricted to 5 lakh only. This 5 lakh of the gain entirely was distributed to the acquirer in the first case. Now it is distributed as 1.67 and 3.33. And in the third part, if you distribute more shares to the Wilson Limited, then the ratio will be like total is 80,000. So the ratio will be 3/8 and 5/8. So 3/8 and 5/8. You distribute that 35 lakh of the after merger market value in this ratio and then again compare it with the pre-merger market value, 10 lakh and 13 lakh. The difference is 3,12,500. This is the gain to the target company, and 187,500 here. when you will compare 21,87,500 with 20 lakhs. So this is the gain to the acquirer, and you will see that the total of both the gains will be 5 lakh only. That's what the impact of merger on both the company. It was an easy question, pretty old one also. Okay, let's come to question number 18 now. So we are practically done with one of the concept that we wanted to discuss. Like since 1 hour we have been discussing this. I will just come to this point. It was true cost of merger, or we can say cost of acquisition. So in order to summarize from all the question, you just have to calculate market value after merger deduct market value before merger of target company. This is going to be the cost of acquisition to acquirer. So if their market value was 50 crore and we are offering them 52 crore, so 2 crore is the cost of acquisition to the acquirer. We are done with the true cost of merger question. Okay, let's come to buyback of securities. I will just take a break and I will be back in 2 minutes now. So welcome back after the break, and this is going to be question number 18, and pretty good question. 18, 19 and 20 I think are on the same concept. 18 and 19 are on the same concept. So let's have a look on question number 18. 19 will be your homework. SK Limited has a surplus cash of 150 lakhs and wants to distribute 30% of it to the shareholder. How much is the 30% of it? 40, we can say 45 lakhs, right? Cool. The company decided to buy back the share. See, when you have a surplus cash and you talk about the distribution to the shareholder, the first thing that comes to our mind is the dividend. But it's not the dividend that we are giving to the shareholders. It's the share buyback procedure. It's the amount that we are giving to the shareholder in order to buy back the shares from them. So we are offering it in the public that whosoever wants to sell their share at this and this price, the buyback policy is going on and you can sell your shares at this price. The company estimate that its share price after the buyback is likely to be 15% above the buyback price. Now it has a practical reason that whenever the buyback is announced by the company, what happens in the market is public thinks that there might be something good which is happening in the company, or if the company is going very good, if the promoters and the owners of the company are expecting a lot to come, a lot of profit or a lot of good projects to come in the future from the company, the owners will try to maximize their ownership by buying back the shares from the public. So buyback of share is a good news for the company in the market, and that's why the market prices normally tend to go beyond their current level. The number of share outstanding at present is 15 lakh with an earning per share of 4 rupees. So practically the total earning is 15 lakhs multiplied by 4, 60 lakh rupees. You are required to determine the price at which the shares can be bought back. Okay, let's say the buyback price is X. If the market capitalization of the company should be 400 lakhs after buyback. If the market capitalization of the company should be 400 lakhs after buyback. What is the formula for market capitalization? Market price into number of share. But if you want this market capitalization to be after buyback, the market price has to be after buyback. And the number of share also should be after buyback. So have a look. This is, I think, question number 18, right? Just a second. Market capitalization is equal to market price into number of share. The only thing that you need to be ensure is, if you want this market capitalization to be after buyback, the market price and the number of shares should also be after buyback. So we want the market capitalization after buyback of the price to be 400 lakhs. Okay, now understand this line. The company estimates that its share price after the buyback is likely to be 15% above the buyback price. What is the buyback price? The price at which the shares can be bought back is X, and 15% above X will be the market price after buyback. So can I say 1.15X will be the market price after buyback? Exactly, sir. Now, what is the number of share after buyback? It's very simple, sir. At present, the number of shares are 15 lakh minus shares bought back will be the balance share after buyback. Do you agree with this? The number of share after buyback will be 15 minus the shares which has been bought back by the company. So this is going to be our equation. Now, 400 is equal to 1.15x 15 minus. How will you decide how many number of shares are bought back? It's very simple, sir. How much amount we want to distribute to the shareholders? 30% of 150 lakhs. So that's 45 lakh we want to distribute the shareholders at a price of buyback price, that is X. So 45 lakhs distribution at X price will give you the number of shares that you want to buy back. Now, in the entire equation, X is the only unknown variable. You can calculate that first. Have a look. 400 is equal to 1.15x. This multiply in bracket 15x minus 45 divided by x. This x and x will get cancelled now. So I will multiply 1.15 inside the bracket. It will be 15 to 1.15, that's 17.25x minus 51.75, and this is 400. So 51.75, when it will go to the left hand side, it will be 415.75 divided by 17.25 is equal to x, and the x will be 26.188, or you can say 19. This is going to be the market the buyback price at which you are going to buy back the shares. Put it in the equation and check once that if your answer is right or wrong. So 26.19 into 1.15, the market price after buyback comes to 30.12 multiplied by 45 divided by 26.19 minus 15, that's 13.28. So 13.28 into 30.12, approximately 400 lakhs. Yeah. So this is your buyback price. This is the price at which you are going to buy back every share. Every means how many shares you are going to buy back? Second part of this question. Number of shares bought back. 45 lakhs you want to distribute at a price of 26.19. So the answer is 171,821. This many number of shares you are going to buy back at a price of 26.19. So what are the question? The price at which the shares will be bought back, the number of shares that can be bought back, and the impact of this on the EPS, assuming that the net income remains same, means 60 lakhs. It will remain same after the buyback. So third part, current EPS is how much? 4. So current EPS is 4. New EPS will be, how will you calculate the new EPS? The earnings after buyback, which will remain same, which is equal to 15 lakh multiplied by 4, 60 lakhs divided by the number of shares left after the buyback. 15 lakh was the original number of shares minus 171,821 because you have bought back this much of the shares. So it will be 15 lakh minus 171,821. So can I write down 60 lakhs divided by 1328,179. 4.52. So you can see there is an increase in EPS of 0.52 rupees per share. Question asked us about the impact on the EPS. It was 4 per rupees per share earlier and now it is 4.52. It has increased. Why it has increased? It's very simple, sir. The earnings has remained same. Now the same earning of 60 lakh rupees which was earlier divided into 15 lakh shares now is divided into only 13 lakh shares. So every shareholder, every share got a little more share of earnings because there are now less number of shares. This is 26.19. This is 171,821 and 0.52. Abhishek, this question is also the price at which the shares will be bought back, the number of shares that can be repurchased and the impact. So you can take it as an homework. I am coming directly to question number 20. Yeah, it is little different. So have a look. Eager Limited has a market capitalization of 1500 crore and the current market price of its share is 1500. So with that said, we can calculate the number of share which is 1 crore. Am I right? Market capitalization is 1500 crore and the market price is 1500. So if you will divide it, you will get the number of shares 1 crore. What else? It made a profit after tax of 200 crore. With that, we can calculate the EPS. And the board is considering a proposal to buy back 20% of the shares at a premium of 10% to the current market price. Now, 1 crore, 20% of the shares means 0.20 crore shares, or we can say 20 lakhs. And at what price? At a premium of 10% over the current market price. So that will be 1650, 1500 plus 10% goes to 1650. 0.20 crore shares you are going to buy at 1650 price. So how much will be the total? The total amount that you are going to distribute is 330 crore. Am I right? Have a look. Number of shares to bought back 20 lakhs at a price of 650. So 650 into 20 lakhs, this is going to be the amount required to buy back the shares, 330 crore. Now, what else? It plans to fund this through a 16% bank loan. That means this 330 crore rupees. What happened in the previous question that we had a surplus fund which we used to distribute to the shareholders to buy back the share. Now we don't have any surplus fund, but still we want to buy back the share. So whatever the fund is required, we are going to take a loan for that at 16% per annum. Now, you are required to calculate the post buyback earning per share. It's very easy. The company's corporate tax rate is 30%. This profit after tax is 200 crore. Now, if you want to calculate the post buyback EPS, please understand the concept will remain same. This is question number 20. Post buyback EPS will be post buyback profit after tax divided by post buyback number of share, right? So let's try doing it. What is your profit after tax right now? It's 200 crore. Convert that to profit before tax. Profit after tax is right now 200 crore. The tax rate is 30%. So profit before tax will be 200 crore divided by, You can take the tax saving on interest directly, but I will just go through a straight method. 70%, that's 285.71. Okay, so that's your profit before tax, and now you are going to take a loan of 330 crore at 16%. So that will be the interest amount that you will be paying, right? So less interest, 330 into 16%, that goes to 52.80. Now the profit before tax, revised profit before tax, is 232.91 less tax at 30% is 69.87. Now the profit after tax is left is 163.04. This is the new profit after tax. Now number of shares left is, can I say, 0.80 crores, because out of 1 crore you have bought back 0.20 shares. So this will be your new EPS. I might be wrong because I have not read the entire question, but that's the prima facie answer. Let me just go through it once. Yeah, it's right. Okay, let's have a look now. So profit before tax 200 by 0.70, 285 crore, less interest, new profit before tax, less tax, new profit after tax, number of shares bought back 80 lakhs. The EPS post buyback is 203.80. It was also 203.80. Do you understand the procedure? The concept remains same. If you want to calculate the EPS post buyback, take everything post buyback. That's it. Otherwise, EPS is equal to profit after tax divided by number of share. Okay, sir, this was question number 20. Let's have a look on question number 21. This is also an interesting one. I think, yes, interesting. Similar to the previous question, have a look. SM Limited has a market capitalization of 3000 crore and the current earning per share is 200 rupees with a P ratio of 15. So 200 with a P ratio of 15. Can you calculate the market price? Yes, sir. How much is the market price? 3000 rupees. So 3000 rupees is the market price. 3000 crore is the market value. Can I say that 1 crore is the number of shares? See, current market price 3000, number of share 1 crore or 100 lakhs. Now the board of director is considering to a proposal to buy back 20% of the share. That means 0.20 crore, that is 20 lakhs. For that purpose they will have to borrow the funds from the market if they don't have the surplus funds. Okay, at a share premium which can be supported by the financials of the company. The board expects the post buyback market price per share of 3057. Post buyback PER will remain same. What is this PER, sir? It is nothing but the PE ratio. Post buyback PE ratio will remain same. This is going to be the post buyback market price. We can calculate the earning per share. The company proposes to fund the buyback or by availing 8% bank loan since available resources are committed for expansion plan. Applicable income tax rate is 30%. You are required to calculate the interest amount which can be paid for availing the bank loan, the loan amount to be raised, and the premium per share and percentage of premium paid over the current market price. A little different but similar to the previous question, but this is going to be a difficult one. Have a look. Now what to do with that? It's very easy, sir. First of all, you find out what is going to be the market value after merger. See, this is question number 21, and let's be clear about couple of things. The post buyback market price will be 3057. If I 3057, see, post buyback market price has to be 3057. Post buyback P ratio will remain same. What is the P ratio at present? 15. So what will happen? This is going to be post buyback earning per share, market price divided by P. So 203.80. Can you just imagine this is exactly the same as the previous question's EPS? This is post buyback EPS. So what exactly we are doing? We are going in a reverse mode as for the previous question. Whatever we did, we are going to go now like this. So with this EPS, we are going to calculate the new profit after tax. Just understand. I will tell you how to do that. With this EPS, we are going to calculate the new profit after tax. We are going to calculate the profit before tax also by just dividing it by 70%. So this is the new profit before tax. This is the old profit before tax. Do you understand? Old profit before tax, new profit before tax, and the difference will be the interest amount, right? Now that interest amount of 52.80 can be like we can raise a loan at 8%, right? So that interest amount should be 8% of the total loan. So what are we going to do? We are going to put 8% in place of this figure, and we are going to calculate this loan amount to be raised in the market. So the first answer is how much the interest to be paid, which will be the difference between both the profit before tax, this one and this one. Do you get that? Now, after putting this amount divided by this interest rate, we are going to calculate the loan amount to be raised. Once you calculate the loan amount to be raised, you can calculate that what is the what is the buyback price, because whatever the loan amount you are going to raise, it will be used to issue the buyback. Like it will be used to buy back the shares, and that is 20 lakh. In this question also you are buying back 20 lakh shares. So the total amount paid divided by 20 lakhs will give you the buyback price, which will be compared with the current market price of 3000 rupees. And you can calculate the premium as well. The last question is the premium per share and the percentage premium paid over the current market price. The current market price is 3000. You just calculate that buyback price. The difference between this and this will be the premium. How will you calculate the buyback price? The loan amount divided by 20.20 crore, the number of shares that you bought back. How do you calculate the loan amount? It's very simple, sir. X multiplied by 8% should be interest that you are going to calculate for this. So everything is going in a reverse mode. Have a look. So this is the post buyback EPS. Now multiply it with the number of share. Post buyback number of share. How much? 0.80. Am I right? Because 20 lakh shares you are going to buy back, and rest of the shares will be the balance. So post, I will just write down profit after tax now. 203.80 into 0.80, that's 163.04. I think it's exactly same, 163.04. Now profit before tax will be 163.04 divided by 70%. So this is the new 232.91. This is the post buyback profit before tax. We will calculate pre-buyback profit before tax. How to do that? The current profit after tax. How much is the current profit after tax? It's 200 of the EPS multiplied by earning per number of share, which is 1 crore. Current EPS, yeah, or else you can do it like this: market capitalization divided by P ratio. So I will just write it down first. Pre-buyback profit after tax is equal to 3000 divided by 15. That's 200. Okay. Now pre-buyback profit before tax is 200 divided by 70%. So this is the scope left, 285.71. See, all in all, you need to compare these two figures. Right now, the profit before tax is 285.71 crore. But after buyback, the profit before tax should be 232.91 crore. So the difference between these two profit before tax is the scope for you to pay the interest. That is the maximum interest that we can pay. Maximum interest that we can pay is the difference between these two, which is 285.71 minus 232.91. That's 52.80 crore rupees. And this interest was calculated as the loan amount multiplied by 8%. Interest rate was 8%. Therefore, loan amount that we have issued is 52.80 divided by 8%. That's 660 crores. This was used to buy back the shares. Number of shares bought back. How much? 0.20. That's the buyback price. 3,000, I think. 3,300. You bought back, your buyback price is 3,300 rupees. Current market price is 3,000 rupees. So premium in rupees 300, right? And in percentage 10%. We paid 10% over the current market price as a buyback price. So 3,300 rupees will be the buyback price for buying back 20 lakh shares. So the loan amount required is 660 crores. We are going to pay interest at 8%, which comes to 52.80. Right now the profit before tax is 285. Once you deduct the interest, the new profit before tax will be 232, which will be then after paying the taxes it will become 163. The post buyback number of share is this much. Post buyback price will come to this 203.80. We will keep the PE ratio as same and the market price will be 3057 post buyback. So this is how the question is. Now you need to understand how the institute is asking the question. See, this was the question asked in November 2018, old syllabus, 5 marks, MTP March 21, new syllabus and old syllabus, and in after March 21, in July 21, old syllabus itself, the question was asked in the exam. So it was from the similar question was asked in the RTP of the same attempt, but the question that was asked in the exam was exactly reverse in calculation as it was asked in the RTP of that exam. So institute can play such games. You need to be very careful about the concepts. We will call it as the same question as asked in exam RTP, but you might say that okay, this is the different question. No, it's not the different question. It was like this given in the RTP and it was like this asked in the exam. So be ready for such surprises. Question number 20. 1 is over. 22 is going to be the next question, sir. Let's have a look. The following are the financial statements of A Limited and B Limited for the financial year 31st March 20. Both the companies are working in the same industry. Now, I think we are done with, let me just go through. Yes. So, just a second. Before moving over to the next question, I would just want to show you a couple of things. Yeah. So if we come to this point, we are done with the buyback price also. The buyback of securities. Now we are heading towards this promoter holding, free float market capitalization, bonus ratio and stock split. So there are going to be few questions on this together. All the concepts will come in different questions. Have a look on this question now. So we have the balance sheets of the two companies given. Have a look. Total current assets, net fixed assets. This is the total assets. Then the liability, equity capital of rupees 10 each. So can we calculate the number of share here? Yes, sir. Divided by 10 rupees. That means number of share is 1 lakh and 80,000 in this case. Retained earning. This also is a part of equity capital. 14% long-term debt. 14% will be the interest rate. The total current liabilities and the total liabilities is this much. It is matching with the total assets. Now the income statement. Net sales, gross profit, operating expenses minus interest. and 7 lakh into 14%. If you will calculate 7 lakh into 14%, it comes to exactly 98,000. Okay, 5 lakh into 14% also 70,000. EBT, tax, PAT, additional information, dividend payout ratio. This is payout ratio applicable on earning per share, market price per share. Okay, you are required to calculate few things. Earning per share. Can we calculate that? Yes, sir. We can calculate the earning per share. It's very simple. We have the profit after tax. We have the number of shares as well. So the profit after tax is this much. We can divide it by 1 lakh and 80,000. We will get the EPS, right? I'm not doing the calculation. It's easy. I'm just moving over now. Then the question is asking you to calculate PE ratio. The EPS has been calculated. The market price is also given. You can just simply take market price divided by EPS to calculate the PE ratio. The next part is the return on equity. How do you calculate the return on equity? Profit after tax for the equity divided by the equity shareholders fund, which comes to share capital plus reserves and surplus. So, just a second. This is the profit after tax given to you in the question, and the share capital is 10 lakh and 8 lakh. Retained earning is 3 lakh. For A Limited, 13 lakhs will be the equity capital, right? So on that you can calculate the ROE, that is return on equity. The next thing is the book value per share. It's also simple. The shareholders fund that you have taken here in the denominator in terms of ROE, the same has to be taken here divided by the number of shares. 1,80,000, that will give you book value per share. Have a look. So this is the profit after tax. You will divide it with the number of share, you get the EPS. Again, you use it with the market price, you will get the PE ratio. Equity fund is, I told you, 13 lakhs and 8 lakhs. That means 10 plus 3. Reserves and surplus will also get added. Divided by equity funds divided by the number of share. 13 lakhs divided by 1 lakh is book value per share. Okay, that is 13 and 10. And what is ROE? Earning after taxes divided by equity shareholder fund. That means profit after taxes. This figure divided by this figure will give you the return. This is the return. This is the equity. So return on equity is this much percentage. Very straightforward question. Everything is given to you. You just have to make sure you calculate it properly. Estimate the future EPS growth rate. How to calculate the growth rate? Sir, it's very simple. Again, return on equity multiplied by that. You just have calculated here. Multiplied by retention ratio. You remember? B into R. B into R. B is the retention ratio. You have been given with the dividend payout ratio. The balance amount will be the retention ratio, which comes to 60% and 40% in this case. Whatever the ROE that you have calculated here, you multiply it with the retention ratio, you will get the answer. See, retention ratio is 1 minus dividend payout ratio, and this is the ROE. So ROE multiplied by retention ratio will give you the growth rate. Good. Now, if on acquisition of B Limited by A Limited, intrinsic value of B Limited will be 20 rupees per share, develop a range of justifiable exchange ratio that can be offered by A Limited to the shareholders of B Limited. What exactly you have to do? You have to calculate a range. In case of range, you have to take the different basis. One basis can be the market price. Another method will be the intrinsic value. Intrinsic value of 20. Now, there is a slight variation, you can say, in the answer of this question by the institute, because when we have to calculate the market price, we have to take the market price as the basis to calculate the exchange ratio. We will be taking this 40 and 15, right? That's correct. That's totally correct. So range means we have to take two different exchange ratios. One basis can be the market price, 40-15. The another basis is intrinsic value, as the question itself is saying something about it, where the B Limited's intrinsic value is 20 rupees. What is the intrinsic value of A Limited? It's not given. So shall we take some other figure? But institute has taken one figure as the intrinsic value of A Limited in the absence of the data given, which is again the market price. Have a look. If you will look at the justifiable exchange ratio, the two bases has been taken. One of the best bases to calculate the exchange ratio is the market price, which is 40 target divided by acquirer, right? Market price or intrinsic value, both are the positive basis, which is higher the better. And in that case, the target divided by acquirer will be the exchange ratio. So this is correct, 15 by 40. But if you will go by intrinsic value, the B limited's intrinsic value is 20. A limited's intrinsic value is not given, and we have assumed 40 as the intrinsic value itself. So that's okay, not a problem, that's not wrong. But there will be a confusion in the mind of students that what should be the another basis. Yeah, one of the bases that can be taken is the book value per share as 1310. That is also right, because they are asking us to calculate the range. That's okay. Move on now. Acha, one more thing is this. Like if we go by intrinsic value, the exchange ratio is coming to 0.5:1. That means half of our share for every one share of the target company. But if we go by the market price, 0.375:1 is the answer. This is better for the acquirer company, as they have to give lower number of their share for every share of the target company. So acquirer will always prefer the lower limit, seller or the target will always prefer the higher limit. Okay, next question. Based on your analysis in 1 and 2, this 1 and 2 where we calculated earning per share, P ratio, ROE, book value, growth rate, whether the negotiated ratio will be closer to the upper or lower range. So this is the upper and lower range, right? Lower range will be preferred by acquirer, upper range will be preferred by target company. Now you analyze the answers you calculated in the first and the second part. I will tell you. You calculated EPS. You can see the acquirer's EPS is higher than the target. P ratio is also higher. Book value per share is also higher. ROE of acquirer is also higher. So acquirer is dominating in situation. Acquirer is in a dominating situation as its numbers are higher than the B limited. In terms of the growth rate also, A limited is having a higher growth rate. So all in all, we can say that when the two people will sit to negotiate the terms of the merger, A limited is in a position to dominate. And that's why A limited side will win, that is lower limit. So it is more, we can say the chances are more that the negotiation will end up closer to lower limit, somewhere near 0.375, you can say 0.40 also can be finalized. That means closer to the lower limit. Why closer to the lower limit? Because it is in favor of acquirer, and acquirer is in a dominating situation if we go through the answers of first and second part, right? Okay, next question. Post merger earning per share. Post-merger earning per share on an exchange ratio of 0.4:1. What will be the immediate accretion, that is gain, and dilution, that is loss, to EPS to the shareholders of both the firm? You just have to calculate the post-merger EPS first, right? What is the total profit after tax? 274,400 plus 119,000, that's 393,400. The number of share of B limited is 80,000 and we are offering only 0.40. That means 80,000 into 0.40, 32,000 share. Post merger number of share will be 1,32,000. 1 lakh of the existing shares and 32,000 of the new shares issued to the target company. Cool, sir. This is going to be the post merger EPS. That's 2.98. Okay. Now we have to calculate the gain or loss as well. What is the gain or loss? Right now 2.744 and 1.4875 is the EPS. After merger it will be 2.98 and 2.98 into 0.4. Equivalent EPS we have to take, because one share of the target is not equal to one share of the merged entity. So 2.98 into 0.40. Equivalent EPS is 1.192. So we can see there is a gain, 2.98 minus 2.744. Gain to the acquirer of 0.236 and 75. Loss to the target company of 0.2955. This is a loss. Let's have a look. So 2955 or 296. This is 236. Gain or loss. Okay. Then estimation of the post-merger market price. How to calculate the post-merger market price, sir? Post-merger market price on the basis of 0.4:1. That means the same ratio. What you will do, you will keep the PE ratio same as 14.58. The acquirer's PE ratio is kept constant in this case. So post-merger market price will look like 43.45. Let's see what the institute has to say about it. So this is 43.45. Got it? Easy. Question number 23 is just like this. I think so. Let me just check. Yeah. Decompose the share price into EPS, PE ratio, ROE, book value and intrinsic value. Then EPS growth rate. Then they are saying that consider the intrinsic value as 25 and then you have to calculate that negotiated terms to be closer to the upper or lower limit. So exactly same question. Take it as homework. Question number 23. Come over to question number 24. AFC Limited wishes to acquire BCD Limited. Again, there is an acquirer, there is a target company. The shares issued by the two companies are 10 lakh and 5 lakh respectively. So we have the number of share AFC BCD 10 lakh and 5 lakh. Calculate the increase in the total value of BCD Limited resulting from the acquisition of the on the basis of the following condition. What is BCD? Acquire BCD. Target. Total increase in the total value of target company. What is the pre-merger value of the target company and the post-merger value of the target company? The difference between these two is the increase. The data. Current expected growth rate of BCD Limited 7%. Expected growth rate under the control of AFC Limited is 8%. So before merger growth rate is this, after merger growth rate of BCD is this. Current market price of AFC, current market price of BCD. Expected dividend per share of BCD is, this is D1, right? 0.60. Now try to understand what is the pre-merger market value? 5 lakh shares into the current price. So can I say 5 lakh into 20, that's 100 lakh is the current market value of BCD Limited. We have to calculate the after merger market value. How to do that? First of all, cost of equity is not given to you. We have to calculate that. So what we are going to do, we have solved such question where the growth rates were given. We will calculate the cost of equity, existing cost of equity. It will be like market price is equal to or we can say cost of equity equal to D1 divided by market price plus growth rate. So dividend is 0.60, current market price is 20 and the growth rate is 0.07. So can I say 10% is my cost of equity? I'm not explaining this formula as it was already done in the Gordon's growth model in the security valuation chapter as well. Even if you will put the Gordon's growth model directly to calculate the market price, you will get the 10% as the cost of equity. So 10% is the current cost of equity. Now calculate the new market price with the new growth rate. That's it. So market price is equal to 0.60 divided by the cost of equity minus the growth rate. Can I say 30 will be the new market price and the market number of shares were 5 lakh. So 150 will be the market value. Right now this is before merger, this is after merger. So can I say what is the increase in the total value of BCD Limited? 50 lakhs. 50 lakhs. 150 minus 100. Very simple. Okay, let's move on to the next part. On the basis of aforesaid conditions, calculate the gain or loss to the shareholders of both the companies if AFC Limited were to offer one of its shares for every 4 shares of BCD. 1:4 is the ratio. 1:4 is the ratio. Now, what will be the market value after merger? It's the same as one of the question that we have done. The market value of AFC Limited is 100 rupees into 10 lakh. That's 1000. Right? 1000 is the market value of AFC. The new market value of BCD is 150. Right? So the total market value will be 1150. Do you agree? Okay. Now it will be divided into the number of shares that both the shareholders are holding. 1150. 10 lakh shares are held by the original shareholders. Plus 5 into 1/4 is the new ratio. 5 lakh shares of BCD Limited and they are only getting 1 share for every 4. So how many new shares that they will receive? 1.25 lakh. So what is the pattern of sharing? 11.25 lakh is the total number of shares. So 10 divided by 11.25 comes to 88.88%. Or if you have to calculate it other way, you can do it like this. 1150 into 10 by 11.25. This is the market value of AFC Limited after merger. Right now they have a market value of 1000. Am I right? 1150 into 10 by 11.25. That's 1022.22. And 1150 into 1.25 divided by 11.25. That's 127.78. Am I right? Question is very clear. Calculate the gain or loss to the shareholders of both the companies. So 1022.22, that's 22.22. And BCD will have a total market value of 127.78. Now understand, this is the total profit or loss to both the companies. This is to AFC, this is to BCD. Okay. 22.20 lakh and 27.78 lakh. You can divide it by the number of share to arrive at the gain per share. 22.20 divided by 10, 2.22 profit per share. Divided by 1.25, that is 22.22 profit per share. So the profit to the BCD Limited shareholder is higher. I will just repeat it entirely once again. Just have a look. That question is very clear that we are going to offer 1:4. Okay. So how many number of shares will be offered? 1.25. The total number of share will be 10 plus 1.25. That's 11.25. What is the total market value? 1150. That is 1150 lakhs. So 1150, I will just write it here. You can calculate it in 2-3 different methods. Total market value is 1000 plus 150, that's 1150, right? Total number of share is 10 plus 5 into 1/4, that's 11.25. Now you can do one thing. You can calculate the new market price also. 1150 divided by 11.25, that comes to 102.22. Now we can clearly see gain to AFC is 102.22 minus 100 was the price, so it comes to 2.22. Gain to BCD. Understand that 102.22 is the price of 1 share after merger, but they had 4 share for this 1 share. For this one share that they are having right now, they had 4 share before merger, and the value of 4 share before merger was 80 rupees. 20 into 4. So 80 minus 102.22 will be comparable. The 4 share before merger is comparable with the 1 share after merger. So the profit to them is 22.22. Very simple. You can calculate the gain to both the shareholders in per share like this, or the other way is 1150 will be divided into two different shareholders. That is 1150 into 10 by 11.25 comes to 1022.22 and 127.78 AFC and BCD. They had a market value of 1100 before merger. So the total profit to them 22.22 and 27.78. So this is the gain in total. You can divide it by the number of share that they are holding. So that's 10 and 1.25. When you do it, the gain will be 2.22 and 22.22. So you might get some confusion because of the similar figure 2222. But ultimately it's coming to the same. Gain to AFC is 2.22. Here also it's 2.22. Gain to BCD is 22.22. Here also it's 22.22. It's the same thing. See. Now value of the company now is 1000 plus 150. 1150 is the total. Number of share is 10 plus 1.25, that's 11.25. The new market price per share is 102.22. 102.22 of one share for BCD is comparable with the 4 shares of pre-merger value, that is 80. So that's 22.22. For AFC Limited, nothing has changed. 100 became 102.22. That's 2.22. Okay, last. Calculate the gain to the shareholders of both the companies once again if AFC Limited pays 22 rupees for each shares of BCD Limited. Now this is fixed. We are going to pay you in cash, I think, 22 rupees. Assuming the PE ratio of AFC Limited does not change after the merger, EPS of AFC will be 8 and BCD is 2.50. It is assumed that AFC Limited invests its cash to earn 10%. Very simple. For BCD Limited, it's a clear-cut answer that their market price was 20 and they are getting 22. So 2 rupees is the gain to them. Simple. Story is over for BCD. Gain to the shareholders of BCD is 2 rupees per share. It's very simple. They had a market price of 20 rupees. They are getting 22 rupees. That's it. But for AFC Limited, you will have to calculate the earning per share after merger or after acquisition of that company. And it's very simple that since you are paying 22 rupees in cash, you are losing out an opportunity to invest the same at 10%. So the interest on that amount will be considered as a loss of income. I will show you how. Third part. This is the question number 24. Third part, first of all, the very simple part, gain to BCD, 22 minus 20, that's 2. Now, gain to AFC, total earnings after merger. I think tax rate is not given, so that will make the question easy. EPS 8 and 2.5. 8 multiplied by 10 lakh plus 2.5 multiplied by 5 lakh. So this is the earning of both the companies merged together. 80 lakhs and 12 lakh. 50,000, that's 92 lakh. 50,000. Okay, that's the total earning less loss of interest opportunity. Since you have paid cash from your company to someone, for buying this company, buying BCD Limited. How much is the cash you have paid? 22 into 5 lakh. You have paid around 110 lakh rupees. And on that you are losing an opportunity to earn 10%, right? Yes. So assuming the PE ratio of AFC Limited does not change after the merger, so you're losing out an opportunity to earn on that comes to around 11 lakh rupees. So practically speaking, effective earning to you is 92 lakh 50,000 minus 11 lakh. That's the effective earning. LT 1 lakh 50,000. Okay, this will be divided by the number of shares that you are holding, and it's 10 lakh only. Understand that you have not issued any new share to the BCD Limited. You have paid them in cash. So the number of share after merger will also remain same. That's 8.15 EPS. What's the PE ratio at present? PE ratio is, can I say 100 is the market price and earning per share is 8. So the PE ratio is 12.5. Yeah. So what is my current PE ratio? 100 by 8, that's 12.5. Can I calculate the new market price now? That comes to 101.875. What was the old market price? 100. So what is the gain to the shareholders of AFC Limited? 1.875. Do you agree on this? This is how. Merge the income of both. You have paid them cash, they have gone to home. Their market price was 20, they got 22, their profit is 2 rupees, that's clear. Now total earning, but because you paid them around 110 lakh, that means you are losing an opportunity to earn that 11 lakh rupees. You have reduced that and you have calculated the new EPS with the same PE ratio, the new market price, and compared it with the old market price. See. So this is 81.50 lakh, new EPS, PE ratio, new market price, old market price, the gain 1.875. So gain to AFC Limited shareholder is 1.875 and to BCD Limited it's clear, gain to the shareholder of BCD is 22 minus 20, that's 2 per share. That's it, simple. Okay sir. Question number 25 is homework to you. Nothing's new, everything is like calculate the market price and the EPS again and again. Let's have a look on question number 26 now. This is quite interesting, it seems to me. Have a look. Okay, this question is, I have read that and it's pretty simple. I will just show you. See, the details of the two companies are given to you. This is acquirer, this is target. The annual earning, number of share, you can calculate the EPS multiplied by the P ratio. You can calculate the market price as well. The stock swap ratio is 3 shares of C Limited for 1 share of P. So this is 3:1 ratio. You will get 3000 shares in place of 1000. That's simple. The total number of share will be 4000 and 3000. That's 7000 shares after the merger. After the merger, it is expected that the earnings will be 8% higher than the combined earnings of the two. So what is the combined earning? It is, I think, 15,800. You can just do it plus 8% and that will be the total earnings. 7000 shares, so total earning divided by 7000, you will get the new EPS multiplied by the P ratio. Okay, it is acha. Further, it is expected that the P ratio of S Limited shall be average of the P ratios of the two companies before merger. Now this time it is the average. What is the average of 8 and 10? The average of 8 and 10 will be 9. That's it. So 15,800 is the total earning plus 8%, divided by 7,000 will be EPS, multiplied by 9 will be the PE ratio. Multiplied by 9 PE ratio will be the market price, the new market price. That's it. Calculate, evaluate the extent to which both the shareholders are benefited per share from the proposed merger. That's it. You have to calculate the gain or loss in per share. That's pretty simple question. 27 is going to be the next question now. Have a look. TK Limited and SK Limited both are in the same industry. The former is in negotiation for the acquisition of later. So, former means this acquirer, this is target. TK Limited is the acquirer who wants to acquire SK Limited. Information about the two companies as per their latest financial statements are given below. TK, SK. 10 rupees equity share outstanding 24 lakh and 12 lakh. 10 rupees equity shares outstanding 24 lakh and 12 lakh. That is in numbers. 10% debenture, 12.5% loan. You can calculate the interest on both the loans. Okay. Earning before interest, depreciation and tax, EBITDA. Market price. So out of this EBITDA you can deduct the interest, you will get the earning before tax. There is no depreciation, no amortization. You can deduct the tax as well at 30%. TK Limited plans to offer the price of offer a price for SK Limited business as a whole which will be 7 times the EBITDA as reduced by the outstanding debt and to be discharged by own shares at a market price. So TK Limited has this plan to buy SK Limited, but SK Limited is planning to seek 1 share in TK for every 2 shares held. So both the parties has 2 different plans of this merger. Okay. Calculate and show the following under both the alternatives. TK Limited's offer, SK Limited's plan. What is the SK Limited's plan? It's simple, 1:2 exchange ratio. But what is the TK Limited's offer? TK Limited's offer is, first of all, they are going to multiply the EBITDA 7 times and then deduct the loan out of it, and this amount will be called as purchase consideration divided by market price of acquirer. This will be the number of share issued. Let's have a look on that. So we have to calculate the net consideration payable, number of shares to be issued, EPS after acquisition, market price after acquisition. State briefly the advantages. See, what will be the market price after acquisition? This EPS multiplied by the PE ratio. What is this EPS? The profit after tax divided by the number of shares to be issued and existing. So let's start with one by one. We are going to solve this. Let's go with this offer first. What is this offer? 7 times the EBITDA, 7 times of this amount. 230 into 7 comes to 1610 less the institutional loan 480. So this is the purchase consideration 1130. As reduced by the outstanding debt to be discharged by its own share. So we have to pay this much of the amount in lakhs to SK Limited, and we are going to pay it not in cash but in shares of our own company. What is the market price of the shares? 220. So 5.136 or 36. 5,13,636 will be the number of share that we are going to issue. Right now we are having 24 lakhs. Okay. Oh, there is one more thing. Depreciation, amortization, EBI, DAT. I was just looking if it is given as after tax or what. So 230 into 7 minus 480 goes to 1130 divided by 220. Right now we have a shares of 24 lakh. So plus 24 lakh goes to 29.13636. So this is the number of share after acquisition. Let's find out the profit after tax of both the companies. We will start with EBI DAT, which is 800 and 230. The very first thing that we should do is deduct the interest. 1160 multiplied by 10% is 116 and 5 480 of the institutional loan multiplied by 12.5% goes to 60. So this will be your profit before tax. 684 170. 684 170. This is your earnings after taxes. No, before tax. So we are going to deduct 30% of the tax from both. That's 478.8. That's 119, and the total is 478.80. 597.80. 597.80. This is your profit after tax of both the companies. This is your number of share after acquisition. This is profit after tax, that is number of share. You will get the new EPS 29.13636. That is 20.5173, or we can say 52. Let's have a look on the answer now. Do you understand? Like, have you understood this? 20.52. See, 20.52. Let's start from the very beginning. 7 times the EBITDA, that is 1610, less loan 480. So the total purchase consideration is 1130 to be discharged at our market price of 220. So the total number of share to be issued is 513,600,000. Okay, round off. So EPS of TK Limited after acquisition. How to calculate that? Total of the EBITDA. Yeah, they have done it in like together. 597.80 is the net profit after tax. I will show the same figure to you. See, 597.80 is the net profit after tax divided by the number of share, which is 29 point something. Yeah, so this is your EPS after. This is under the plan of acquirer, who says that I will pay you 7 times your EBITDA minus the loan. So 1130 lakhs is what I am ready to pay at my market price. So I will issue 5,13,600 shares to you. The moment I will issue that, my total number of share will shoot up to 29.136 lakhs. So that 29.136 lakh shares, merged entity, the profit after tax of the merged entity will give you the post-merger EPS. This post-merger EPS, when will multiplied by the PE ratio, have a look. Pre-acquisition PE ratio. How to calculate the pre-acquisition PE ratio, sir? EPS, I will show you. You don't have to do this much of the calculation here. You just have to make sure that 470.80 was the profit after tax earlier, and you had around 24 lakh shares, right? So 478.80 divided by 24 lakhs. 478.80 divided by 24 lakhs, that comes to 19.95 was the EPS. So EPS was 19.95. So with the help of this market price and EPS, can I calculate the pre-merger PE ratio, which comes to 11.030275. See, 11.03. You just have to do it like this. For acquirer, profit after tax divided by number of share, you will get EPS, take the market price of 220, and you will get the PE ratio of 11.03. EPS was around 19.95. The number of shares 24, and the profit after taxes was 478.80. So this is the PE ratio. Now, what is the market price after merger? The current PE ratio and the new EPS. New EPS after merger that you had just calculated, 20.52. This is going to be the market price, 226.34. See, 20.52 and 11.03. So this was the offer of acquirer, that I am going to pay you in this manner. The plan of the target company is very simple. I will take 1 share for every 2 that I am holding. So I was holding around 12 lakh shares. 12 lakh shares, right? So I will take around 6 lakh shares for that. Let me just do the calculation here. How many shares that I was holding? SK Limited was holding around 12 lakh shares. So 1:2 comes to 6 lakhs. Okay, how will you decide the net consideration payable? 6 lakh shares of TK Limited. Acquirer will be given at 220 rupees. So 6 lakhs into 220 will be your 13,20,000. 1320 lakhs will be your purchase consideration. I will just write down the answer here for question number 27, the second part only. Number of shares to be issued, 12 into 1/2, that's 6 lakhs. Purchase consideration 220 for one share, the market price, into 6, that's 1320 lakhs. Profit after tax, or EPS, I think, right? EPS after acquisition is the profit after tax divided by number of share. What is the profit after tax of both the companies? 597.80 divided by the number of share, 24 plus 6, that's 30. That's 19.93. Market price. How will you calculate? EPS multiplied by the PE ratio. 19.93 multiplied by the P ratio that we have just calculated is 11.03. We can use that here. This is 19.93 and 11.03. It should have been 11.03. Okay, 11.03. That comes to 219.83. More appropriate. See, 6 lakhs. So instead of doing this 12 lakh into 110, 6 lakhs into 220 will be more appropriate. EPS after merger 597 divided by the number of share. This is the post merger profit after tax, post merger number of share, post merger EPS multiplied by the PE ratio, market price. Last question is a little interesting. State briefly the advantages of TK Limited from acquisition. It's very simple. The question is asking you, what will be the benefit of merger in this case? It's very simple. You can reduce the cost. Like I told you an example of Tata Motors and tire company. They can reduce the cost of the tire right now to them, because right now they are buying the tire which includes the profit of the other company. But once you buy the other company, the profit can be reduced, or the cost can be reduced to a maximum level. Second thing, you get the synergy benefit. Third thing, I told you an example of Jio and Airtel, where you will get the monopoly or dominant situation. So you can increase your market share as well. You can dominate in the market. So you will have some synergy benefit too. Also, you will be able to reduce the multiple costs, like accounts team. There are 2 accounts team right now. So after merger, I think only 50% of the other team will be required, not the entire 100%. Right now, let's say for example 100 people are sitting in this company and 100 people are sitting in that company. After merger, 200 won't be required. The maximum people that will be required is only 150, because there will be one delegation of the authority will be to one person now for anything. Right now there are 2 people for every thing, for payment authorization, for payables, for receivables, and many things. So you will reduce the employee cost as well. You can utilize the rent, the space also. So advantages of acquisition is synergy, cost reduction, operating efficiency. What is operating efficiency? Like I will tell you. For example, I have a automobile I am an automobile manufacturing company. I want to acquire the other company, let's say Mahindra and Tata Motors. Now both the companies are manufacturing car. Both the companies have the plant, manufacturing plant. But let's say for example, both the plants capacity is 1 lakh units per year, but they are producing only 60,000 and 60,000 units every year. So both the companies, understand, both the companies are underutilizing their capacity. What will happen is that after merger they can utilize the one plant at full capacity, because they will require 1,20,000 units and the capacity is 1 lakh units, so they can utilize it. So that is operating efficiency, better market share, they can avoid the competition as well. So there are many examples like this. This is the similar question as 27, so I'm putting it for homework. See, net consideration, number of share, EPS, market price and advantages. Everything is same. So take it as an homework. Now, this is going to be a question where we are going to start a few things. Let me just explain that to you. So we are going to start this promoters holding, free float holding, free float market capitalization, bonus ratio. These 4 concepts will be learned by you in the coming 10 questions, I think. Let's have a look on the new question. That's question number 29. Let's have a look now. Question number 29. The following information is provided relating to the acquiring company Efficient Limited and the target company Healthy Limited. So there are 2 companies. This is acquiring company, this is target. Let's have a look on the number. Please focus on that. Number of shares 10 lakhs and 7.5 lakhs. The market capitalization is also given to you. With the help of the number of share and market capitalization, you can calculate the market price, which comes to 50 and 100. Yes. Okay. 500 by 10. 750 by 7.5. So this is the market price. When it is divided by the PE ratio, you will get the earning per share. That's 5 and 20. Reserves and surplus is given to you. You can calculate the share capital. How to calculate the share capital? Number of share. The face value multiplied by the number of share. 10 multiplied by 10, that is 100. And 7.5 multiplied by 10, 75. What is the shareholders fund? Shareholders fund is 300 plus 100, that is 400. And in this case, 240 if it is required at all. Okay. Promoters holding in number of share. Now who are the promoters? The owners. All the number of shares, the total number of shares are divided into 2 parts. The promoters holding and the free float holding. What happens in the promoters holding is they normally do not sell their shares for a long period of time. So if I say that 70% is the promoters holding, that means 30% is held by the others, like mutual funds, retail investors, public in general. That 30% is available to freely float in the market. So tomorrow if you want to buy the share, you will be buying it from this 30% if someone is ready to sell, because promoters is mostly like they do not sell it. So if the promoters holding is this much, you can divide it by the number of share to calculate the percentage of promoters holding. So if I divide 4.75 lakhs, have a look, 4.75 lakhs by 10, can I say that 47.50% is the promoters holding? Yes, sir. Let me just do it here. Acquirer target. Total. 10 and 7.5. Promoters holding 4.75 and 5. So free float holding will be 5.25 and 2.5, right? So if you want to calculate the promoters holding in percentage, it is 47.50. Free float holding in percentage is 52.50. In this case, it is going to be 66.67% and 33.33%. So it is just a calculation that I did. It's not like everything will be required out of that. Board of director of both the companies have decided to give a fair deal to the shareholders, and accordingly for swap ratio the weights are decided as 40, 25 and 35% respectively for the earning, book value and the market price. Till now you have seen questions where only one basis was taken in order to calculate the swap ratio, that is exchange ratio. In this question you will learn how to calculate the exchange ratio based on the three different bases. Whenever more than one basis is considered, you have to consider the weightage of each. So you calculate the earning per share of both the companies, book value of both the companies, market price of both the companies, and then multiply it with the weights given to you. You will get the exchange ratio. Calculate the swap ratio and also calculate the promoters holding percentage after acquisition. Okay, let's do that. I will solve this one question entirely because after that around 3 to 4 questions are on a similar pattern. So I will leave that up to you. That's why I'm solving this question entirely, so that you can have a good idea about it. This is question number 29. See. We have lots of data. Market price EPS. Market price we have calculated as 50 by 100. EPS 520. And book value per share. Okay, book value, I will take it according to the sequence it is given. Earning per share 5:20 and mark book value per share. How to calculate the book value per share? It's the total shareholders fund 400 divided by the number of share, which is 10. So it will be 40. Do you agree? 400 divided by 10, 40. 240 divided by 7.5 lakhs. So this will be 32. Do you agree with this? Book value per share. So I will take the book value per share as 40 and 32. Market price as 50 and 100. So this is acquirer, this is target. These are the data. Now you can understand that all the factors are positive factors, higher the better. The formula for exchange ratio will be target by acquirer. So 20 by 5 exchange ratio will be 4:1, right? In this case it's 0.8:1, right? And in this case it is 2:1, right? Now take the weights that has been given in the question. The weight is 40, 25 and 35. 40%, 25% and 35% of the weightage. Just multiply. So understand that this is 1, 1 and 1. So no matter how much you multiply by to the 1, the total will always be 1. So it doesn't make any sense multiplying the weights to this part where the 1 is written. You have to just do it like this. 4, 0.8 and 2. You have to multiply the weights with this figure. So 4 into 0.40, exchange ratio multiplied by weights will be can I say it is 1.6, and this is 0.2 and this is 0.70. That comes to 2.5. If you want to multiply, you can take it as 0.40, 0.25 and 0.35:1. Again it will be same. Doesn't make any sense multiplying 1 with the weights. So 2.5:1. What does that mean? The swap ratio is 2.5 shares of acquirer for 1 share of target. You can clearly see that we are paying almost 2.5 times what they are having in number of share, because we are buying a better company than us. See, Efficient Limited's market value is 500 lakhs, whereas Healthy Limited's market value is 750 lakhs. So we are buying a bigger company than us. and that's why we are paying more number of share. We are giving them more number of share. How many shares will be issued? 7.5 lakhs into 2.5. Total number of shares. We are already having 10 lakh shares and we are going to issue 2.5 shares to 7.5 lakhs. So 2.5 into 7.5 plus 10. The total number of shares will be 28.75 lakhs. Do you agree with this? Now the promoters holding. It's very simple. Promoters were having 4.75 lakh shares in 10 lakhs, right? This is 4.75 lakh shares in 10 lakh shares. Now, and in the target company, the promoters were holding 5 lakh shares. If the 7.5 lakh shares of the target company is getting 2.5 each, that means the 5 lakh which is included in the 7.5 lakh, these guys are also getting the same number of shares. So how many shares of acquiring company has been issued to the promoters of the target company? 2.5 each. So 5 into 2.5 will be the promoters shares issued in the new company. 4.75 were the already promoters. Now the new promoters will be 5 into 2.5. Do you agree with this? So the total promoters holding in the company will be 17.25 lakhs. Try to understand. Out of 7.5 lakh shares, 5 lakh shares were held by the promoters itself. So if you want to say that every shareholder is getting 2.5, the promoters will also get the 2.5 shares in the acquiring company, and that will also be called as the promoters holding. So promoters holding is 12.5 and 4.75, that is 17.25 lakhs. So what is the percentage of holding? Promoters holding in total after merger company. 17.25 divided by 28.75, that comes to 60%. 60% of the total after merger company is held by the promoters. That is 17.25 lakh, and the balance will be free float market. Okay, so that was the answer to your first question, that what is the swap ratio? 2.5, and what is the promoters holding? 60%. First question. Now, second part. What is the EPS of Efficient Limited after acquisition of Healthy Limited? Very simple, you have to, EPS is not given. Total earnings divided by the number of share. So, post-merger EPS. Total earnings, or we can say profit after taxes of both the companies divided by the number of shares. How to calculate that? We can calculate it using EPS multiplied by the number of share. So what is the EPS? Can you calculate this? EPS is 5 multiplied by the number of share 10. 50 lakhs for acquiring company plus, can I say 20 is the EPS of target company multiplied by 7.5 is the total number of share. So 20 multiplied by 7.5, and the total number of share is 28.75. So that's 200 by 28.75 comes to 6.9565. 6.9565 is the post-merger EPS. Very simple. You just take the total earnings of both the companies and divide it by the number of share. Now, the third part. What is the expected market price per share of and the market capitalization of Efficient Limited after acquisition, assuming that the P/E ratio of Efficient Limited remains unchanged? What is the P/E ratio? It's 10, my friend. 10 is the P/E ratio. So we have to calculate the expected market price. Let's keep the P/E ratio same. Which is 10. So what will be the market price post merger? 69.75. 56 or 57, whatever you want to take, and market capitalization. How do you calculate the market capitalization? Market price into number of share, which is 69.56 into 28.75 is the number of shares, 28.75 lakhs, right? That comes to somewhere 2000, round of lakhs. It is just because of the rounding of 1999.85 is the answer. If you take it 69.57 into 28.75, yeah, so 2000.14 will be the answer at that time. So round off to 2000 lakhs. So this is the market capitalization post merger. Okay, then calculate the free float market capitalization of the merged firm. It's very simple. If the total market value is 2000, 60% of that goes to promoters and 40% of that goes to the free float holding. Let's start with the answers now. EPS, book value 4032, market price 50 and 100. With these three bases, we calculated the exchange ratio of 2.5. Have a look, that's 2.5, and total number of shares were 28.75 lakhs. 28.75, 17.25 in 28.75 was 60% was the promoters holding. Now the second, third and the fourth part calculated together, can I say this is 19.9, if you multiply it like this, if you don't take it in a round off, then the exact answer is 1999.85 lakhs. So this is going to be your third answer, right? And what is the fourth answer? See, whatever the market value, 40% of it is free float holding. Free float, because 60% is the promoters holding. So you can directly calculate 40% of the total market value. That's it. Simple. Next question is quite similar to the previous one. Let's have a look. Number of share, market capitalization. Again, you can calculate market price. Just apply your brain. Start thinking. Market price into PE, market price divided by PE ratio, you will get the EPS. EPS multiplied by number of share, you will get the total earnings. Okay, reserves and surplus is given. You can get the share capital by multiplying 10 with 20 and 15. So reserves and surplus plus share capital divided by the number of shares will give you book value. So all the three things you can calculate, and then you can apply these three weights, exactly similar to the previous question. So in this question, your exchange ratio will come to 2.688. So the total number of share will be like this. 15 lakhs the target company shares, you are going to issue 2.688 to everyone. So 40.32 will be the new number of shares. The new number of shares that you are going to issue. The total number of share will be 60.32 at that time, because existing number of share is 20 lakhs and 40 lakhs. So that is 60.32. In this question also healthy and efficient is given. So almost everything is same. You will calculate the total EPS after merger. With the help of that, you will keep the PE ratio same, calculate the market price, then market capitalization, then free float capitalization. So leaving it up to you. In this question, number of share, market capitalization, again you can calculate the market price, then PE ratio, reserves and surplus, promoters holding, everything is same. Again 40, 25 and 35 is given to EPS, book value and market price. You have been asked to calculate the current market price, EPS and book value for this ratio. Then calculate the swap ratio, promoters holding, EPS, market price, free float. Everything is exactly in the similar manner. So I am keeping that to you. Okay, this question. Again, you have 25, 50 and 25% to the book value, earnings and market price. And see, percentage of shareholding of promoter, a little different from the previous question. Instead of the number of shares, they have given you the percentage of holding of the promoter. So this is the promoters holding, total share capital, free, reserves and surplus. So it will come to 1100 lakh and 700 lakhs. So that 1100 lakhs and 700 lakhs, what you can do is you can calculate the number of share also. See, share capital is 200 divided by paid up value. So you will get the number of shares as 2 lakh and 100 of the share capital and 10 of the paid up value, so 10 lakh. So number of share will have to be calculated. Acha, the good part about this in this question is free float market capitalization is given this time. From the previous 3 question you have been calculating the free float market capitalization. In this question it is given. So what you can do is you can take the free float holding from this percentage. See, 50% is the free float holding and 40% is the free float holding. So you divide the free float holding and you will get the market value of each company. When you will divide the free float market capitalization with the free float holding, you will get the exact market value. Acha, when you will divide the number of share that you have just calculated here, like 2 lakh and 10 lakh, you will get the market price of each share. You have the PE ratio also here. You divide it by the PE ratio, you will get the earning per share of each company. You have also, you can get easily the book value per share. Have a look. 1100 lakh, 900 plus 200, 11 lakh. 1100 lakh divided by the number of share. 550 will be the book value per share. So you will get the book value per share. Now you have all the 3 things that is required for calculating the swap ratio. See, you have market price, you have EPS and you have book value. Book value, EPS and market price. All the 3 things you have calculated there, just a little difference. Then you have to calculate the swap ratio. Then post merger, book value, EPS, market price. How to calculate? It's very simple. Whatever the shares are right now, we have 2 lakh shares. How many shares we are going to issue? Let's find out the swap ratio. I will just take it from here, and the swap ratio is coming to 0.148825. Now try to understand. You have 10 lakh shares in the target company. 0.148825, that means you are going to issue 1,48,825 shares. You already have 2 lakh shares. You are going to issue this much. The total number of share will be 348,825. Okay, what is the total capital? Very simple, sir. Let me just... Now, how are you going to calculate the total capital? This is one tricky part. Understand the total capital of both the companies 1100 lakh and 700 lakhs. I will just write it here. This is question number 32. 1100 lakh and 700 lakhs. So the total assets of both the company comes to 1800 lakhs. Okay. In that 1100 lakhs, we have 900 and 200 as the share capital. Cool. And what are we doing? We are adding 148.83 lakh in the share capital. We are issuing the number of shares at a paid up value. So the share capital will be 348.83 and 900 is already available to you as a reserves and surplus. So what will happen? Out of 1800 lakh, you will deduct this much value, and the balance will be the reserves and surplus, capital reserve. You do not take this value forward in your company after the merger. That 700's bifurcation is not at all important, because that company, target company, will cease to exist. The net assets of the company is 1800 lakhs. So what will happen? I will tell you the entry in your books. The entry in your books for this 700 lakhs, because you are acquiring that. So you will debit 700 lakhs of the net assets. Okay, and it will go to share capital and reserves and surplus. Share capital is like 148,823, whatever it is, somewhere around 148 point. When you multiply it with 10 rupees, so that will be 148.825. See, when you multiply it with 10 rupees, 148.825 will be credited to the share capital. And the balance of 551.175 will be credited to the reserves and surplus. So this is how it is going to look. 551 and 900 will be the reserves and surplus. So this 1100 lakhs will match, no doubt about it. But this 700 lakhs will have a different type or different structure, because we do not carry forward the target company's structure of equity, share and reserves and surplus. This is the net assets. We are going to pass the entries of that 700 of the net assets like this. The share capital of 148 and the balance will be the capital reserve, which is 551.175. In total, it will match up to 1800 lakhs. Don't worry about it. In total, it will be 1800 lakhs. So how do you calculate the book value? The book value is very simple, sir. Book value per share will be very simple. You can just take the total of both. So this is 1800 lakhs in the numerator divided by the number of shares, 348.825. So that is 3.48825 in terms of lakhs, number of shares. So there is one correction here. It is not in rupees. $3.48825. So this becomes the book value after merger. Then comes the EPS. EPS is just the total profit. You can take the total profit. This is the EPS of both the companies. You can multiply it with the number of share, and that will be the total profit divided by 3.48825. There are only 2-3 things that you have to calculate: book value, EPS, and market price. So EPS will be the total profit divided by 3.48825 earning per share. Okay, when this is multiplied by the existing PE ratio, you will get the market price as well. See, total profit 100 lakh and 97.50 divided by the total number of shares, that's 56.62. This 56.62 when multiplied with the existing PE ratio, which is 10, you will get the market price of each share, 566.20. Almost same. Acha, this question is important. I will take this question. This is the question which will solve the part of the previous question as well. This question includes some bonus shares and stock splitting that we are going to discuss. That is written in the concept part also, which I discussed in the very beginning. So let's start with the question number 33. We are going to solve it thoroughly. See, the following information relating to the acquiring company Abhiman Limited and the target company Abhishek and Abhishek. Okay. Share capital. Achha, the promoters holding is 50% and 60%. So can I write down free float holding is, I will just write it here, 50 and 40%. So the moment I will divide free float market cap with the free float holding, I can get the total market value, which comes to, let me write down. So the market value will be 800 lakhs, right? 400 divided by 50% and 128 divided by 40% comes to 320 lakhs. This is lakhs, this is lakhs. Cool. We have the market value ready with us. Now, share capital and free reserves and surplus will be the total shareholders fund, that will be 1,600 lakhs. Paid up value is given to you. Share capital divided by paid up value will give you the number of shares, which will be 200 by 100, that's 2 lakh. 100 by 10 is 10 lakh. Exactly like the previous question. Okay. And what else? Free float market capitalization. We can calculate the market price also. Market value divided by the number of shares. So 800 by 2. The market price will be 400 and the market price here will be 32. Right? We can also calculate the book value per share because we have the shareholders fund 1000 divided by number of share. So we can calculate the book value per share as well. Book value per share 500 and this will be 60. So we have all the three things again to calculate the swap ratio, which are EPS. We need the EPS as well, right? So let's find out the EPS first. How to calculate the EPS? See, total market value 800 divided by PE ratio. You can simply calculate 800 by PE ratio 80. 800 by 10, 80, or else you can calculate market price divided by PE ratio multiplied by number of share. It will again come to 80. So EPS is 80, 800 by 10 and 80, 320 by 4. Just have a look. 320 by 4, 80. So we have the This is total earning, right? This is total earning. Sorry, it's not EPS. This is profit after tax. Now we can calculate the EPS as well. When we divide the profit after tax, you have two ways to calculate the EPS. You can divide the profit after tax with the number of share, 80 by 2, that's 440, or 400 of the market price divided by PE ratio 10, 40. Again the same thing. So EPS will be 40 and 80 by 10, that's 8 rupees, or 32 by 4. Yes. So these are the data. Very easy. If you want to do it, the table is here right now. So I am not just framing the entire table now. So I will just write down the EPS is 48, market price is 432, book value per share is 560. With the help of this book value, EPS, market price, let me write down the figures. All the bases are positive and we can calculate, we can say all the bases are positive and higher the better. That's why the formula will be target divided by acquirer. So the target's book value is 60 divided by 500. Am I right? That comes to 0.12:1. Then earning per share is 8 by 40. Target divided by acquirer. 8 by 40. That's 0.20:1. Then market price 32 by 400, that's 0.08:1. So this is the ratio. Now you can multiply straight away these percentages with the ratios. So 0.12 into 25% comes to 0.03:1, not is to 1, 0.03, right? Then 50% of 0.20 comes to 0.10, 25% of 0.08 comes to 0.02, and the total will be 0.15:1. That means for every one share, understand, every one share of Abhishek Limited, we are going to issue 0.15 shares only. So total number of share is 10 into 0.15, that's 1.5 lakhs. 1.5 lakh shares we are going to issue. At present we have 2 lakh shares. So the total number of shares will be 3.5 lakh after merger. Remember that. Okay. What will be the total profit after tax after merger? 80 plus 80, that's 160. So can we calculate 160 of the total profit after tax after merger divided by the number of share? We will get the post merger EPS. Now, what the question is asking us? Promoters revised holding in the Abhiman Limited. Try to understand. This was 2 lakh plus 1.5 lakh and 3.5 of the total shareholding. So 50% is the promoters holding, that means 1 lakh. 60% is the promoters holding, that means 9 lakh. So can I say out of 3.5, 1.9 lakh is the promoters holding, that comes to 54.29%. 54.29% is the promoters revised holding in the Abhiman Limited. They have 1.9 lakh shares out of 3.5. Okay. Free float market capitalization. Very simple, sir. Try to understand. If 1.9 lakh shares are held by promoters, the balance share will be a free float share 1.6 lakhs. You just have to calculate the post merger market price. How to do that? Try to understand. I will just take it here. Profit after tax post merger is 80 plus 80, 160. Post merger number of share is 3.5 lakh. So post merger EPS is 45.71. What is the PE ratio of the acquirer? We will keep that as constant. It is 10. Okay. So PE ratio post merger is 10. Market price post merger is 457.10. Right. How much is the free float number of shares? It is 1.6. So 1.6. Or we can do it later on as well. What I will do here is I will take total number of share as 3.5. This is going to be total market value. 457.10 into 3.5. That's 1599.85. Round off to 1600. This is the total market value. How much is the free float holding, sir? Free float holding is 54.29%. Sorry, free float holding is the balance now. That's, I can take it like this as well here. 1.6 lakhs into the number of market price now 457.10. There are two ways to calculate this. That goes to 731.36 lakhs free float market capitalization. Or else what you can do is you calculate the free float holding, that is 1.6 by 3.5. That comes to 45.71%. So that 45.71% you can multiply with the 1600 also to get the free float market capitalization. Cool. So that is your first answer. Third answer. Okay, we by default we started with the third answer automatically. Promoters revised holding, free float market capitalization. Let me complete this. What is the book value, EPS and expected market price of Abhiman Limited after acquisition? So we have calculated the EPS. Post merger EPS is this, post merger market price is this. What will be the book value and how to present it? See, the total net assets of the Abhishek Limited is 600 lakhs. So how to write it? Share capital, reserves and surplus of acquirer is right now 800 lakhs. Right? Now you are issuing, the new company is coming into your company that you are merging with the other company. So net assets will be debited with 600 lakhs because the net assets will be 500 plus 100, 600 lakhs. But you are issuing the shares to them worth 1.5 lakh of 100 each, right? So 150 lakh will go to the share capital. I think 100 each is the paid up value. In Abhiman Limited, every share's paid up value is 100. So if you are issuing 1.5 lakh, the share capital will only get credited with 150 lakh and the balance amount will go to reserves and surplus, which is 450 lakhs. So I am going to write it like this: 200 plus 150 plus 450. Automatically 600 is credited, but in this manner. So it will be 350 and 1250. That's 1600. 1600. So try to understand this 600 of the capital after merger will look like 150 and 450, not just 100 and 500. This will cease to exist. This will cease to exist, this company, and the capital will be 150 and 450. So 1600 is the total book value divided by the number of share 3.5. You will get the book value per share as 457.14. 457.14, as good as the market price. Okay, let's check these answers first. This is book value, market price, EPS, swap ratio. See, book value 1600 divided by 3.5, that is 457, EPS and the market price, all of them are given at one place. Then the promoters revised holding is 54.29. The total market value 731.36 is the capitalization. Now is some interesting part that you are going to learn. So we have done everything. Please focus on this part. Also calculate the number of share, earning per share and book value. If after acquisition of Abhishek Limited, Abhiman Limited decided to issue bonus shares in the ratio of 1:2 and split the stock as ₹5 each fully paid up. Right now it is 100 each. If you want to split the stock from 100 to 5, you have to make 20 parts of every stock. So, see, right now the share capital is looking like yeah, share capital is looking like this for both the companies. We can say 350 and reserves and surplus of 1250. Okay, now what is happening? We are issuing the bonus share of 1:2. For every 2 share, one bonus is being issued. What will be the entry? The entry will be reserves and surplus debit to share capital, because the bonus will be paid from the reserves and surplus itself. How many number of shares are issued? Right now 3.5 lakh shares are there, and for every 2 shares you are issuing 1 share. 3.5 divided by 2 comes to 1.75 lakh of 100 each. That means 175 lakh you are going to debit to the reserves and surplus and credit to the share capital. So if you do that, it will be like 175 added in the share capital, 175 deducted from the reserves and surplus. So 350 plus 175, it will look like 525, and 1250 minus 175, it will look like 1075. Total is same, but now we have 5.25 lakh shares of 100 each. 5.25 lakh shares of 100 each. 3.5 plus 1.75 because of the bonus issue. Now, if you do the stock split, what will happen? Stock split does not changes the share capital and reserves and surplus total. It will change the paid up price and the number of share. See, stock split from 100 of, like we can say 5.25 lakhs. Right now we have, just a second, 100 to 5 rupees per share, right? So we have 5.25 lakh shares of 100 each. How many shares of 5 each will make 525 lakh? It will be multiplied by 20. That's 105. When you multiply all the shares with 20, it will be 105 lakh shares of 5 rupees each. So in a better manner, if you want me to present, it will look like this: 105 lakhs shares of rupees 5 each. So the total will be 525. And reserves and surplus will be 1050, I think 1075. The total will still remain 1600. It was 1600, it is 1600, but the number of share and the paid up value has changed. Now what the question is asking us to calculate? We had, have you understood this process? 3.5 lakh shares. We issued bonus. So 1:2. The bonus was 1.75 lakhs. That comes to 5.25 lakhs. And after that we split the stock into 5 rupees each. 100 divided by 5, that means every stock will be now converted into 20 stocks of 5 each. So that will be 105 lakh. So from 3.5 to 5.25 to 105 lakh we have come across, right? So what we have to calculate? The number of share, which is now 105 lakh. What is the EPS? Sir, 80 plus 80, 160 is the total profit after tax. It will now be divided with 105. It comes to 1.5238. Again, they are asking the book value, 1600 divided by 105. That's 15.24. So these three are the answers: 105 number of share, 1.5238 my EPS, and 15.24. Now let's have a look on the answers. See, revised capital 350 lakhs plus 175, so 525 lakh shares. 525 lakhs 1075 plus 525. Yeah, that's correct, but there should be a bracket. I will just make sure. Okay. So revised capital is 525 lakh share capital. Number of shares split 5.25 to 105. So you can see EPS is 80 plus 80, 160 lakhs of the profit of both the company. 105, 1.5t. Book value is 525, 1075, that is 1600 by 105, that's 15.238. Understand the stock split and bonus issue. We had 3.5 lakh, we issued 50%, 1:2, that means 1.75, it became 5.25, then we split the stock, it became 105. That's it. So everything, market price, book value, EPS will reduce by 20 times because we have multiplied the shares by 20 times. Got it? This is your answer. Question number 34 onwards we are going to discuss in the next lecture. For the time being, bye bye sir.